Credit card defaults are now rising faster than during the 2008 financial crisis. Americans used to save around 10% of their income from the 40s through the 1970s, but today, savings relative to that income is shrinking, and people are spending way more than they earn. This change in spending habits due to inflation has led to over $1 trillion in credit card debt. That's double what it was 10 years ago. In 2023, U.S. consumer debt reached a whopping $17 trillion, mainly due to mortgages and overpriced housing, similar to the pre-2008 crisis conditions. The Housing Affordability Index has hit its lowest level ever, making homeownership increasingly out of reach for many people. And the home prices now cost more than 7 times the annual household income, obviously making homeownership extremely expensive and unattainable to a majority of Americans. Many people have depleted the savings that they built up during the 2020 pandemic, as evidenced here by the personal savings rate. Consumers are burning through their savings at an unprecedented rate, with credit card debt growing. Credit card interest rates have soared to a record 21.5%. That's nearly double what they were just 2 years ago, and there's no signs of this actually slowing down. As a result, delinquency rates on consumer loans have surged dramatically in the past 2 years. High rates and rising costs are putting a lot of pressure on consumers. While they remain resilient for now, there's not much runway left. Americans are increasingly saving less for emergencies and leaning more on credit card debt, including buy now, pay later options. And this trend persists despite the yield curve indicating a high probability of a recession. If a recession occurs, the government will likely need to print more money to offset the reduced savings, which could result in even higher inflation rates than what we've experienced so far. The government deficit is worsening, and there's little expectation for improvement in the near future. 94 U.S. banks are at significant risk of experiencing bank runs due to exposure to losses from real estate and unrealized securities losses. The Bank of New York Mellon has a 100% ratio of uninsured deposits, followed by State Street Bank, Northern Trust, Citibank, HSBC, JP Morgan, and U.S. Bank. 7 of the 33 banks with more than $100 billion in assets are above the threshold, reporting a 50% or higher ratio of uninsured deposits to total deposits, and at elevated risk of financial runs. These 94 banks are at increased risk of having a liquidity crisis out of the 1,028 banks with more than $1 billion in assets, according to the Florida Atlantic University College of Business. The first bank failure of the year, 2024, was Republic First Bank from Pennsylvania, and they were number 87 on the previous quarter's list with a 51.5% ratio. 3 of the 4 largest bank failures in recent U.S. history occurred in 2023, and they were precipitated by rapid withdrawals of uninsured deposits following adverse news about the bank's risk to exposure, with growing concerns about unrealized losses on investment securities and commercial real estate loans. The risk of another depositor run on banks grows every single day. The services industry now accounts for 72% of U.S. GDP, which is up from 60% in 1990. Meanwhile, the ISM Manufacturing PMI Index has shrunk in 20 of the last 21 months, marking 22 months without 2 consecutive readings of an expansion. This is the longest streak since the 1990s. Services are keeping the U.S. economy alive. For now, I remain invested in long positions in the stock market that have direct correlations to the SPY. I'm also a holder of heavily shorted equities that run inverse to the SPY and fiat currencies, such as silver, gold, the VIX, GameStop, AMC stock, amongst others. And that we are literally watching gold make new all-time highs at this very moment. That options long call premiums of GameStop have increased by nearly $1 million today alone, indicating that there are some big players taking long options positions. while put premiums are down. GameStop has over $4 billion in cash on hand and zero debt. AMC Theaters just had their best June of all time in their 103-year history. They have reduced their debt by $2 billion in the last 3 years and extended debt maturities to 2029 and beyond, with the ability to reduce debt by an additional $464 million through conversion of exchangeable notes into equity. Please do your own research and due diligence, as this is not financial advice. The SEC is suing Virtue Financial for stock market manipulation and front-running retail trades. Virtue Financial has motioned to dismiss this case last Friday, but the judge, John Codall, stated that there has never been a case like this before and denied their motion for dismissal, alleging the defendants allowed nearly unrestricted access to material, non-public information and misled customers. Subscribe to this channel and follow me on Twitter for more information like this every single day at BossBlunt1. Retail investors are fed up with Wall Street and government overreach. It is time for change. And if you're ready to help enact change, follow our company on Twitter at Lit Exchange LLC. Lit is developing an upcoming stock and crypto broker to avoid dark pools and prevent market manipulation of your orders. Lit Exchange Founders Program raised nearly $250,000 in 24 hours. You can own the company now via our Regulation CF on the FINRA-approved funding portal, Silicon Prairie. Founders Program has raised over $250,000 in around 24 hours. You can own the company via our Regulation CF Founders Program on the FINRA-approved funding portal, Silicon Prairie, at the website below. You will be able to find the pitch deck, the business plan, the offerings, executive summary, and much more in full detail there. Check it out.